The Swiss government banned insurance profits years ago, yet the average Swiss citizen pays more out of pocket for healthcare costs than the average American. How is this possible? It defies everything that we're told about healthcare economics. And if you ask the typical American why the US pays so much for healthcare, you're usually gonna hear one of two answers. Some might say big pharma upcharging drugs, but more likely they'll blame the corporate greed of huge insurance companies. The prevailing narrative out there is that private health insurance companies are prioritizing their billions in profits over patients. We hear about costs rising for Americans, people getting denied, $100 million plus profits year after year from these corporations. And there is some truth in all of this, since Americans still pay a lot more for healthcare overall than Switzerland. So what would happen if the US government just put an end to all of this? Basically, no more profits for insurance companies. Well, we don't have to guess at what a version of that might look like. Switzerland did that back in 1996. And on paper, these two healthcare systems actually share some similarities, the healthcare systems of the US and Switzerland. Neither country uses a government-run single-payer system like Canada or the UK. Instead, they both rely on a decentralized market of private competing insurance companies. So there is at least something to be learned here. So what happens to a multi-billion-dollar healthcare market when you legally destroy the profit motive? Does removing corporate greed wind up just shifting the financial burden directly onto patients? To find out the truth, I followed the money. Let's dive in. To understand the appeal of outright banning insurance profits in the US, we first need to understand how the US government already regulates insurance companies and their profit model, and the twisted incentive that it creates for those insurance companies that most have never heard of. Under something called the Affordable Care Act, private US health insurance companies are governed by a metric called the medical loss ratio, or often shortened to MLR. By federal law, if an insurance company provides insurance for its employees or a small business, they must spend at least 80% of every dollar that they're paid directly on medical care or quality improvement. For large companies, the mandate rises to 85%. So that remaining 15 to 20% is all they're allowed to keep for admin, marketing, and corporate profit. And on the surface, this actually sounds like a great way to protect Americans from excessive insurance profits. If an insurance company only spends 75% on care, they're legally required to issue cash rebates back to their customers. And this happens from time to time, but let's take a look at the math from a corporate strategy perspective. If your net profit margin is legally capped at a strict percentage, how would you grow your nominal dollar profits for your Wall Street shareholders next quarter? You can't increase your percentage margin to 25%. It's locked in at 15 to 20% by federal law. The only mathematical way to increase your absolute dollar profit is to allow costs to rise. If you make 5% profit on a $1,000 premium, you make $50. But if the underlying cost of hospital stays, surgeries, and drugs inflates so much that the premium rises to $2,000, that same 5% margin now gives you a $100 profit. Now, this is a bit of a paradox in the short term because insurance companies might battle each other to offer lower rates to companies who get insurance with them so that they can beat out their competitors. Basically, if they offer lower rates, a company will decide to get insurance with them instead of another option. But zoom out at the macro level here. Over the long haul, every single major insurance company will structurally benefit if the cost of healthcare keeps going up. And one quick thing to point out here, this really doesn't affect large US corporations who pay their employees medical bills out of their own pocket and oftentimes will just pay an insurance company a flat admin fee to manage the network. But for the companies that it does apply to, the MLR mandate structurally disincentivizes American insurance companies from aggressively lowering healthcare costs. The system rewards them when healthcare becomes more expensive because a rising tide lifts all admin caps. So let's take a look at how Switzerland attempted to eliminate the insurance company profit problem. Under the Swiss Federal Health Insurance Act, known as KVG, every resident is required to purchase basic health insurance. And roughly 40 private insurance companies compete on the open market to sell these plans. But the Swiss government implemented a rule that insurers are legally prohibited from making a single cent of profit on basic health insurance. Every dollar of profit that doesn't go to admin must be used on medical care or medical claims. If a Swiss insurance company accidentally runs a surplus at the end of the fiscal year, they cannot distribute it to shareholders or pay out executive bonuses like they can in the US. Furthermore, every single insurance company is forced to offer the same benefits package. They cannot deny anybody for pre-existing conditions, and they can't alter the price based off somebody's health history, something that goes for the US as well. So if these Swiss insurance companies can't make a profit and they can't cherry pick the low-cost, healthy individuals, then why wouldn't the system collapse under adverse selection? Or in non-insurance terms, the ultimate industry nightmare where all the healthy people decide to just skip buying insurance, leaving the system stuck with only sick patients and massive medical bills it doesn't have the cash to pay for? Well, two main reasons. reasons. Switzerland mandates healthcare coverage for everybody, but also something called risk equalization. So instead of letting these insurance companies fight over healthy patients, the Swiss government runs a massive, continuous, data-driven fund. Insurance companies who happen to sign up younger, healthier pools of clients are hit with a mandatory financial penalty. That cash is then systemically transferred to the competing insurance companies who took on an older, sicker, and more expensive patient. So then these Swiss insurance companies have to make money the hard way. They have to run a hyper-efficient business. And they also use health insurance to just get you in the door so they can make the real money upselling you on other coverages like dental, vision, and private hospital wards, which don't cap profits. But all that's a story for another video. What happened to Switzerland's healthcare costs when they banned insurance profits? So with corporate profit completely banned from the equation and insurance companies that are hyper-focused on efficiency, you'd expect this to be the moment where healthcare costs plummet. But they didn't. In fact, Switzerland officially has the second most expensive healthcare system on earth, eclipsed only by the US. And I'd argue that a lot of our spending in the United States is avoidable considering 25% of our budget goes to admin, roughly $1 trillion, and 300 billion of that is considered just bureaucratic administrative waste. If our insurance companies were as efficient as Switzerland's insurance companies, our healthcare costs would probably be even closer. But the point here is that when you strip out the insurance profit motive, you don't automatically get cheap healthcare. I think when you look at the healthcare systems of both of these nations, a clear trade-off emerges. The United States attempted to regulate insurance companies using percentage caps, unintentionally creating a system where insurance companies could benefit from rising medical inflation. Switzerland successfully eliminated the profit motive from basic care and built a highly efficient risk equalization market, but they didn't really get affordable healthcare. Instead, they got a high-performing, incredibly expensive system where the average citizen in the upper middle class must personally pay the raw cost of medical delivery without an employer to take care of most of the bill for them. And I personally believe that the real problem with American healthcare costs is that the system makes it profitable to fail at controlling those costs. Simply capping insurance profit won't automatically fix the massive underlying cost of hospital consolidation, bureaucratic waste, and high pharmaceutical prices. It might help a little bit, but it's definitely not going to solve all of our healthcare cost issues. If you found this video interesting and you'd like to see more in healthcare in the United States, please consider subscribing for more. This is Tyler Detchover. Thanks for watching.